Welcome back to the channel, friends. Today is January 1st, 2026, and we have a detailed, careful update to discuss, presented in plain language for anyone following the stories of the Iraqi Dinar and the Vietnamese Dong. Let's be clear from the outset, over the past year, the nature of the conversation has shifted significantly. We are moving away from realms dominated by speculation and hopeful chatter and into a space where tangible, technical activities within the global banking system are being observed. Insiders and users within financial institutions are reporting concrete steps, system updates, internal testing protocols, and bookkeeping alterations that typically only occur when the financial world anticipates a currency will see an important change in its role or status. Stick with me for the next while as we walk through exactly what these signs look like in practice. We'll explore why banks undertake this kind of preparatory work, examine what Iraq and Vietnam are doing on the policy side of the equation, and discuss what this confluence of factors might suggest for observers. Most crucially, we will cover the realistic caveats and the practical signals that hold the most weight. My aim is to speak plainly, avoid sensationalism, and ensure you understand why these behind-the-scenes technical moves can be meaningful indicators to monitor in the coming months. This is strictly an evidence-based breakdown of why banks prepare in advance and what that preparation can tell us. It is not, and should not be construed as investment advice of any kind. To begin with a clear summary, banks do not, as a rule, reprogram their teller interfaces, update internal lists of currency codes, or install new exchange rate data feeds without a compelling reason. These changes are expensive, they require rigorous testing to ensure stability, and they inherently introduce operational risk. Therefore, financial institutions only commit resources to such tasks when they expect a currency's status or role in the market to change in a measurable and significant way. Over the past 12 to 18 months, we have witnessed two overlapping patterns emerge. The first pattern exists at the policy level. Both Iraq and Vietnam have been actively engaged in macroeconomic and banking reforms designed to modernize their financial systems and make their respective currencies more functional and accessible for international use. The second pattern is operational, occurring within the walls of banks themselves. Certain global and regional banks, along with numerous smaller correspondent banks, appear to be conducting quiet integration work and system testing specifically for handling the Iraqi Dinar and the Vietnamese Dong. When viewed together, these patterns create the kind of environment that banking professionals interpret as a signal to get ready. This does not automatically imply an imminent, sudden price spike or an immediate redenomination. What it does suggest is that financial infrastructure is being aligned so that the global market can cope efficiently and without disruption if and when the relevant policymakers decide to act. This interplay between policy readiness and operational preparation forms the core narrative we will unpack today. It is helpful to explain in simple terms why this preparatory phase is so critical for banks. Imagine a major financial institution as an immensely complex machine comprised of countless interconnected subsystems. These include accounting ledgers, anti-fraud engines, treasury management systems, payment rails, liquidity feeds, compliance monitors, foreign exchange platforms, and regulatory reporting tools. If a currency is poised to transition to a new role, whether through redenomination, enhanced convertibility, or inclusion in new types of cross-border transactions, every single one of these subsystems must be meticulously updated and tested for compatibility. If one system, for instance, still treats the dinar or dong as a non-settlement currency with limited liquidity, while another suddenly begins to accept it for settlement, the bank risks catastrophic failures. These could manifest as rejected payments, severe accounting mismatches, and serious breaches of regulatory compliance. The work to prevent this chaos happens quietly and well in advance. In the plainest language, banks prepare to ensure stability and continuity. These preparations take the tangible form of software code updates, test transactions with partner banks, new exchange rate feeds in back-office systems, and updated options on teller and branch user interfaces. These are not marketing maneuvers or public relations exercises. They are essential engineering and operational steps taken to safeguard the institution's functionality. With that framework in mind, let's turn our attention to the Iraqi side of the story. Officials from the Central Bank of Iraq and the government have, for some time, discussed ongoing currency reform efforts. These long-running dialogues have included considerations of redenomination, the process of removing zeros from the currency, and broader modernization of the national currency system. Public reports and statements indicate that Iraqi authorities continue to revisit the concept of redenomination, while also confirming that digital currency projects and broader modernization initiatives are under active study and in various stages of planning. These policy conversations are fundamentally important because a formal redenomination or comprehensive currency reform is, first and foremost, a sovereign policy decision. It requires detailed plans from the central bank, legal steps through the government and parliament, coordination with the national treasury, and finally, execution by private and correspondent banks. When a central bank signals that such work is active and strategic, it serves as a cue for the private banking sector and the international correspondent network to begin aligning their own systems. They prepare to process whatever new mechanics the central bank ultimately decides to implement. Therefore, the public communications and official roadmaps from Iraq's banking authorities are a key component in understanding why correspondent banks around the world might initiate technical preparations at this juncture. On the Vietnamese side, The narrative follows a different but equally significant path. The State Bank of Vietnam, alongside other official agencies, has been diligently working to maintain the stability of the dong, manage domestic liquidity, and modernize the nation's payment infrastructure. This work is set against the backdrop of Vietnam's rapidly growing economy, which has established the country as a major export and manufacturing hub. Policy documents and official statements over recent years reveal active management of the exchange rate, steps to enhance liquidity management and payment channels, and pilot programs aimed at upgrading digital and institutional infrastructure. These sustained policy efforts improve the foundational environment for banks to accept and process the Vietnamese dong more widely, whether this involves developing better application programming interfaces, APIs for foreign banks, clarifying reporting rules for international investors, or improving the mechanisms for managing liquidity between offshore and offshore markets. The effect is the same. When a nation's central bank actively stabilizes its currency and refines its payment systems, that currency naturally becomes a more viable candidate for broader integration into the global banking tapestry. This, in turn, prompts correspondent banks to update their own systems to accommodate potential new flows and transactions. We should strive to be precise about the specific types of bank-level changes that have been reported by observers and insiders. The most common, practical, and verifiable activities include new currency placeholders appearing in drop-down menus on teller or back-office software interfaces. They also include internal test transactions recorded in bank logs that simulate settlement processes using the IQD or VND. Furthermore, observers note new instrument codes being added to internal rate feeds, updates to anti-money laundering rule sets that incorporate parameters for these currencies, and the preliminary establishment of liquidity lines or correspondent relationships denominated in dinars or dong. Independent analysts and some reports from within banking institutions have highlighted these exact patterns in various geographical regions. These activities represent the mechanical, technical signs that banks exhibit when they are in the process of updating business software entries, running test files, and arranging liquidity provisions. It bears repeating, these moves are operational and procedural, not promotional. They are the practical, often mundane steps institutions take to prevent systemic breakdowns in the event a currency is slated to assume a larger role in commerce or finance. Several market observers and community-contributed documents have presented examples, such as bank screen images or test run logs, as anecdotal evidence of this activity. While these items do not constitute formal confirmation from a central bank, they do form pieces of a larger operational picture that is consistent with preparatory work. It is crucial at this point to explain the distinction between policy and operations, as conflating the two often leads to confusion. Policy is the domain of central banks and governments. It involves decisions like whether to redenominate a currency, allow greater foreign access, or alter capital control rules. Operations, on the other hand, encompass what commercial and correspondent banks do to implement those policies once they are decided. This includes writing new code, conducting system tests, and setting up technical connections with other banks. Policy authorization must logically come first. A central bank has to officially sign off on a redenomination or new settlement rules. However, operational work frequently begins early because technical readiness is a prerequisite for a smooth rollout. A useful analogy is bridge construction. The Transportation Ministry decides the bridge should be built, but contractors begin surveying, designing, and sourcing materials long before the official groundbreaking ceremony. When operational movements are observed in parallel with credible, ongoing policy discussions, the combined signal becomes notably stronger. This is precisely the dynamic many people are noting with the Iraqi Dinar and the Vietnamese Dong policy. Level work continues in Baghdad and Hanoi while separate, parallel operational preparation is reportedly underway inside various correspondent and regional banks internationally. Now, it is essential to insert a short but critical reality check. The public information ecosystem on this topic generally consists of two distinct types of data. The first type is official government and central bank announcements. These are formal, deliberately paced, high-confidence communications. The second type is market-level anecdotal reporting, which includes items like bank screen videos, user-submitted images, and community forum posts detailing test codes or new listings inside local bank branches. This second type is faster moving, noisier, and carries a lower confidence level initially. Both types of information matter, but they carry very different weights. Official policy announcements confirm governmental intent and provide the legal and regulatory cover for any future action. Anecdotal operational evidence, when verified, can show that the market machinery is beginning to move in anticipation, preparing for a durable market-changing event such as a redenomination or a shift in convertibility rules. The most meaningful scenario for watchers is the convergence of both a clear public policy decision and visible, coordinated operational readiness among major correspondent banks. That convergence is the key signal to monitor closely. Let's delve a bit deeper into the Iraq-specific policy path and the practical steps involved in a potential redenomination or broad currency reform. Typically, redenomination involves three major stages. The first is the design and legal authorization phase, where the plan is drafted and passed into law. The second is the communication and logistics phase, which covers how to exchange old banknotes for new ones and how to handle the accounting transition. The third is the system implementation phase, where banks, payment processors, and international correspondents technically execute the change. The central bank usually announces the policy framework and steps first, followed by a public timetable. After such an announcement, private and correspondent banks begin their operational testing in earnest. This includes running sample transactions between institutions, updating accounting tables, and configuring compliance rules to handle the change seamlessly. This entire process can span from many months to several years, as currency redenomination is a profound alteration to a nation's financial core. Public reporting throughout 2025 suggests Iraq's central bank continues to treat this as an active project, which provides context for why the private banking sphere and its international partners might see a reason to prepare. However, a plan being active is not synonymous with an immediate switch. It indicates that the country and its partners are methodically lining up the legal, logistical, and technical pieces required to make a future switch orderly and secure whenever it may occur. On the operational side, it's instructive to understand how banks conduct tests and why evidence of those tests might appear publicly. When a bank decides to add or change its support for a currency, it first creates internal records code values for the currency, accounting rules entries in exchange rate feeds, and testing endpoints in its systems. Then, it typically runs sandbox or controlled environment transactions with a trusted correspondent bank to verify that settlement and reconciliation processes work correctly. Following this comes more rigorous penetration testing and compliance reviews. Anti-money laundering systems must be calibrated to classify and flag suspicious flows involving the new or modified currency parameters accurately. Treasury systems must ensure liquidity coverage ratios and overnight processes remain intact. These tests can manifest as temporary placeholds on some banks' internal displays and sometimes as log files from test runs. On occasion, vigilant customers or employees may capture screenshots or short video clips of these internal displays and share them. Such posts are anecdotal, but when they appear from multiple unrelated sources, they can be consistent with the known operational steps banks undertake to ensure they can go live safely. This patterned sandbox testing followed by staged integration checks is exactly what would occur if major financial institutions intended to accept more liquidity or settlement activity in a given currency. Shifting focus, let's cover Vietnam's macroeconomic story in a bit more detail because it provides important context. Vietnam's rapid growth as an export and manufacturing powerhouse creates intrinsic demand for more functional, reliable payment rails and for more flexible handling of the dong within international trade and investment flows. The State Bank of Vietnam has not been passive. It has actively managed exchange rate policy, intervened in markets to smooth volatility, and implemented measures to support onshore liquidity while modernizing payment channels. This creates a more predictable and structured environment in which correspondent banks can contemplate scaling up their VND services. Clearer rules surrounding foreign investor accounts, improved onshore liquidity management tools, and a more transparent intervention policy from the central bank all reduce operational uncertainty for international banks. When a central bank demonstrates such sustained management and the underlying macroeconomic signals remain supportive, international banks logically respond by preparing their internal corridors and compliance frameworks to efficiently accept and process those future flows. This underlying dynamic helps explain why observers of the VND are also reporting operational signs at the banking level. You will often hear discussions centered on bank screens or test files as proof that something is happening. It is important to be precise about what these items can and cannot demonstrate. A bank screen that briefly lists the IQD or VND as a selectable option is evidence that the bank has added a corresponding code and user interface element to its system. This is an operational decision. It proves the bank has, at a minimum, considered or tested the integration of that currency. It does not, however, prove a final policy action by a central bank, nor does it guarantee an immediate change in exchange value or an imminent redenomination. Think of it instead as a readiness flag. It shows technical preparedness at one specific node within the vast, global financial network. This kind of readiness increases the overall system's capacity to act without disruption if a policy decision occurs, but it is not, in itself, that policy decision. The responsible way to interpret such screens is as operational corroboration of ongoing policy discussions, supporting evidence but not the primary catalyst. Let's go deeper into the practical risks and caveats, as this topic naturally attracts a spectrum of wishful thinking and extreme interpretations. First, it must be understood that no degree of operational readiness guarantees an immediate market-moving event or what some might term a miracle. Currency redenomination, in its standard form, is designed to preserve real purchasing power by adjusting nominal units. It is not inherently a value creation event for holders. Second, operational testing can be highly localized or experimental. A bank in one region or country might test a currency while many other major global players do not, meaning isolated tests may not imply imminent, universal acceptance. Third, external factors such as geopolitical shifts, legal challenges, or macroeconomic shocks can delay or entirely alter policy decisions. A sudden fiscal stress, a regional conflict, or a change in government priorities can push reform timelines back by years. Finally, there is always a risk that anecdotal reporting is misinterpreted, taken out of context, or even intentionally exaggerated. This is precisely why a disciplined approach combines official policy signals with multiple, independent operational signals before drawing any firm conclusions about the imminence of a major market shift. Maintaining a degree of healthy skepticism toward grand claims and focusing on convergent data points is paramount. So what are the realistic potential outcomes if the current convergence of policy modernization and operational bank readiness continues to develop? We can consider a few broad scenarios. In the first scenario, small to medium-scale upgrades occur. Banks enable more extensive handling of the Dong and Dinar for specific trade and correspondent services. The currencies gain modestly greater international usage, and liquidity improves gradually over time. This would be a technically significant evolution, but likely not accompanied by headline-grabbing revaluation events. In a second scenario, a formal redenomination or a major policy change is announced by a central bank, accompanied by a carefully managed public exchange program. This would require heavy coordination across the financial ecosystem and would trigger operational systems to go live across many banks simultaneously. Depending on the precise policy details, this could result in a major market repricing and significant operational adjustments worldwide. In a third scenario, plans stall or are delayed indefinitely. Operational work might continue in the background for contingency purposes, but the political or economic decision to act is postponed. The task for serious observers is to assess which of these scenarios the evolving evidence best supports and to update that assessment as new information emerges. How should everyday holders or interested parties interpret these developments? Emotionally, it is easy to become swept up in cycles of hope or anxiety. Practically, it is most useful to treat these developments as one would view any complex infrastructure upgrade project. They are steps that reduce the likelihood of chaotic failure if a policy action is taken, and they raise the probability that such an action could be implemented smoothly. They do not by themselves determine market prices or outcomes. Therefore, individuals should aim to remain calmly informed. They should track the formal policy signals from official sources and avoid making significant decisions based on single-source anecdotes. If you are a trader or financial professional, you would likely look for arbitrage or execution opportunities only after formal announcements are made. If you are a long-term observer or holder, your focus should be on verified policy progress and verified operational readiness across multiple major correspondent banks, not just isolated examples. In all cases, emphasizing verified cross-checks over viral uncontextualized clips is the prudent path. I want to take a moment to discuss realistic timelines and expectations, as this is a common point of inquiry and also one of the most challenging aspects to address. There are generally 3 phases to most credible currency transitions of this nature. The first is the pre-announcement alignment phase, which can last from many months to several years. The second is the public announcement and legal steps phase, which may take weeks to months depending on political complexity. The third is the operational rollout and exchange phase, which can unfold over days to months following an official announcement. Banks tend to be most visible during the pre-announcement testing phase and the rollout phase. The public announcement window itself is usually quite narrow and meticulously crafted by authorities to avoid causing market panic or instability. The governing principle for authorities is typically to ensure the market is operationally ready, not to surprise it. This means that if you see a growing volume of operational activity without an accompanying public policy announcement, it could simply indicate that the process is still in that extended pre-announcement alignment period. Technical teams are, to extend our earlier analogy, building the bridge before the political leadership officially sets an opening date. I also want to be explicit about the kind of reporting that should be treated with great distrust. Be wary of unnamed social media posts that promise guaranteed revaluations on a specific, fixed date. Be cautious of screenshots shared without clear provenance or explanation of their origin. Be skeptical of channels or sources that appear to monetize fear, urgency, or the promise of inside information. Financial markets ultimately move on confirmed policy and verified, large-scale operational readiness, not on viral hype or sensationalist claims. Always seek corroboration across at least 2 high-quality, independent sources before adjusting your personal expectations. If you are not a professional trader or banker, the best defensive posture is often to remain informed and patient while consciously avoiding major financial decisions based on single-source unverified claims. Now, let's briefly consider how global bank networks and international standards factor into this process. Modern international payments rely on established standards like specific ISO messaging formats, SCEFT connectivity protocols, and standardized rate feeds. Upgrades to accommodate a changing currency role must be implemented within these existing frameworks and often coincide with industry-wide upgrade schedules. When a currency's functional role is anticipated to change, banks must add that currency to their messaging dictionaries, ensure adequate liquidity coverage for clearing, and test new correspondent arrangements. This process is highly procedural, well-documented, and not something reputable banks undertake lightly or without cause. When multiple banks across different jurisdictions begin to show similar operational changes, it suggests a degree of alignment around the same technical standards and a shared, industry-wide understanding of a policy possibility. This multi-bank alignment becomes an important corroborating data point. What are the potential downsides and risks to this overall narrative? First and foremost, governments can and do delay or retract reform plans for a multitude of political, fiscal, or strategic reasons. Second, operational tests can be limited to narrow pilots that never scale up if key counterparties or market conditions don't materialize as expected. Third, global events, such as the imposition of new international sanctions, sudden shifts in major interest rates, or escalating geopolitical conflicts, can force a country to reprioritize its reform agenda, pushing currency modernization down the list. Finally, the proliferation of misinformation can create false hope and lead to poor financial decisions by individuals. These are very real risks. That is why anyone engaged with this story, whether as a holder, a speculator, or a casual observer, should adopt a conservative approach to claims and prioritize diversified, information-driven understanding over reactionary decisions. As we begin to wrap up this core analysis, here is a straightforward, plain language takeaway. The combination of active, credible policy discussions in Iraq and Vietnam, plus the visible operational readiness work within sectors of the global banking system, provides a plausible and coherent explanation for the uptick in bank testing and internal currency listings that people are reporting. This combination does raise the probability that one or both currencies could be integrated into broader banking systems in a more meaningful way in the future. However, it does not guarantee a sudden, miraculous, or immediate revaluation event. A more accurate way to view the current period is as a phase of infrastructure alignment. The technical and operational bridge is being constructed. If and when the respective governments give the final policy signal, traffic, in the form of transactions, settlements, and exchanges, can then move across that bridge much more safely and predictably than it could if no preparatory work had been done at all. Before we finish, a very important reminder must be reiterated. This channel and this discussion are focused on explaining news developments and interpreting operational signals within the financial system. This is not and should not be taken as investment advice. If you are considering making significant financial decisions based on this or similar information, it is essential to consult with a licensed, qualified financial advisor who can consider your complete financial picture and risk tolerance. The best practices are to stay informed, verify claims with independent and reputable sources, and keep an eye on the concrete, high-value signals we have outlined. Emotional decisions based on viral clips or unsubstantiated rumors are precisely what lead to costly mistakes. In these matters, patience and diligent verification are your two most valuable allies. In closing, thank you for engaging with this long-format, plain language update. Banks prepare because they have a professional and operational imperative to do so. The technical steps we are seeing are consistent with serious readiness procedures. Iraq and Vietnam have public policy signals that make such readiness a logical and meaningful response from the international banking community. The combined picture is one of strategic alignment rather than an immediate guaranteed event. Continue to watch for the key indicators, formal central bank announcements, coordinated correspondent bank pilot programs, and operational confirmations that span multiple jurisdictions and institutions. I will continue to track these high-value signals and provide calm, factual updates as the situation evolves.